Hello, everybody. Today we're going to be doing Chapter 1, lecture for Chapter 1. Just a few things here. One more time. I did the Introduction to the Course video this morning. It pretty much just goes over what's expected of everyone and goes over the syllabus for the course, which is located up here at the top if you haven't seen it before or saw it already. Next, I want to make sure everyone does this introduction form. Get on here and introduce yourself to the class. Just your name, where you're from, your personal interests. We need to have this done by Saturday, August 22nd at 11:59 p.m. I go into more detail on that in the introduction to the course video there, so you can watch it in that. But pretty much everyone just needs to have that in. It's a check-in point to make sure everyone's doing what they're supposed to be doing in the course. I'm going to be going off these PowerPoints today, so we'll go ahead and get into that for Chapter 1. Chapter 1 is business combinations, in particular new rules for a long-standing business practice. So our Chapter 1 learning objectives, we want to describe the major economic advantages of business combinations, also differentiate between accounting for an acquisition of assets and accounting for an acquisition of a controlling interest in the common stock of a company. We also want to explain the basics of the acquisition model, allocate the acquisition price to the assets and liabilities of the acquired company, demonstrate an understanding of the tax issues that arise in an acquisition, explain the disclosure that is required in the period in which an acquisition occurs, and then apply the impairment test to goodwill and adjust goodwill when needed. The 8th learning objective, well, I'm not going to get into that. It's the last slide. I'll touch on it, but I'm not concerned about estimating the value of goodwill. You're not likely to see that on a CPA exam if anyone would want to sit for it. So I'm going to try to keep my efforts here focused on stuff that I know is the most stuff that's just a lot of the meat, I guess you could say. So what are some economic advantages of combinations? Business combinations are typically viewed as a way to jumpstart economies of scale. So pretty much savings can result from the elimination of duplicate assets. So if companies, if they combine, then they might not need as many physical locations, so they can get rid of some of their property, plant, and equipment and stuff of that sort. So they could have a big savings there. Both companies might utilize common facilities and shared fixed costs. So once again, we're getting rid of some of the overhead here with these buildings and stuff. And there could even be more further economies of scale from the advantages of combinations by maybe even one management team replacing two management teams. So these are all good economic advantages of business combinations. There are also different types of mergers. First, we have the backward vertical integration. What this is where a company moves down the production marketing cycle, supplier of products or services it provides. Next, we have a forward vertical integration. This is where a merger happens when a company moves up the production marketing cycle by acquiring a company that uses its products. As far as horizontal merger, this is a merger of a company that offers similar products or services and are likely competitors in the same market space. Product extension merger is a merger where the acquiring company is expanding its product offerings in the marketplace in which it already sells products and services. The market extension merger, this merger increases the geographic market coverage of the same products or services already offered by the acquiring company. The conglomerate merger, this is an acquisition of a firm in an unrelated line of business. So pretty much the acquiring firm has a portfolio of investments. So they're just looking to get into different lines and different industries. Okay, some possible tax advantages. You can accept stock to create a tax-free reorganization, whereas opposed if you accept cash, then you have an immediate gain, which is taxable. So that's nice. You can defer your taxes by accepting stock. Transferable carry forward feature of net operating losses. So if the acquiree, the company that we're purchasing or taking control of, if they have a net operating loss that carry forward that they're applying to net against their income, we can actually take that and apply it to the acquirer's net income. So that's a nice little feature with the business combination. and then net taxable income reported for the consolidated company. Okay, acquisition of control. So let's talk about some acquisition of assets. So we acquire directly from the target company. We assume there are liabilities, and we either pay it in cash, debt, or equity. So obviously, cash, we know what cash is, the currency. Debt, by issuing bonds, stuff of that sort, or even equity by issuing shares of stock, like common and preferred stock. Stock acquisition, that is done where you usually purchase more than 50% of the target's voting common stock, which gives you the controlling interest. This creates a parent-subsidiary relationship. Okay, separate legal entities remain. So in a stock acquisition, there's three different levels. You probably remember from intermediate. You can carry it at cost if it's less than 20%. If you have more than 20%, it's considered you have significant influence, and you carry it using the equity method. And then if you have more than 50% of the voting stock, then you have a controlling interest, and that requires consolidation at the end because it's a parent-subsidiary relationship. So you can either take acquisition of control through acquisition of assets or through stock acquisition, but you have to have more than 50%. Acquisition of control, defense against unfriendly offers. So we have different forms here of ways that we can protect ourselves from being taken over. First, we'll start with greenmail. Greenmail is if the target company may pay a premium price to buy back its own shares. It may either buy shares already owned by a potential acquiring company or purchase shares from a current owner who it is feared would sell to the acquiring company. So greenmail is just a way of trying to take away from another company acquiring them. Next, the white knight. This is where the target company locates a different company to acquire a controlling interest. This could occur when the original acquiring company is in a similar industry, and it is feared that the current management of the target company would be displaced. So that's what a white knight would be. The poison pill. The poison pill involves the issuance of stock rights to existing shareholders to purchase additional shares at a price far below fair value. The rights are exercisable only when the acquiring company purchases or makes a bid to purchase a stated number of shares. So that's what the poison pill is. Selling the crown jewels. This is where the management of the target company sells the vital assets, i.e. the crown jewels, of the target company to others to make the company less attractive to the acquiring company. And then lastly, here we have leveraged buyouts. And this is where the management of the existing target company is going to attempt to purchase a controlling interest in that company. And often substantial debt will be incurred to raise the funds needed to purchase the stock, hence the term leveraged buyout. Okay. So that's a little bit on how we can defend against an unfriendly offer or unfriendly takeover. So what are the accounting ramifications of asset acquisition? So acquiring company records assets and liabilities. Subsequent accounting procedures are the same as for any single accounting entity. So as far as the accounting ramifications, makes sense because it says that we have to assume all liabilities and subsequently the accounting procedure, of course, for any single accounting entity. The only difference is at the end of the Okay, accounting ramifications for a stock acquisition. The parent records an investment, so they're going to have an actual investment account on their balance sheet. Entities with their own separate sets of accounts and separate financial statements. So they're going to remain separate here, right? They're separate accounting entities, but they're going to be one economic entity, and we'll get to that later in this course. Consolidated financial statements reflect the presence of one economic entity. Well, there it is right there. So what we mean by that, one economic entity. So the operations of the subsidiary is in effect, or is in essence, the operations of the parent. So we have to record that as one company because it's considered one economic entity, right? Whereas they're separate accounting entities because they have their own records and maintain them separately. So that's the difference between an accounting entity and an economic entity. So what about the evolution of accounting methods? So before 2001, the purchase accounting recorded net assets at the fair value. And there was the pooling of interest method in which you would record net assets at their book value and then a merger of equals, specific qualifying criteria. Okay, I'm not really gonna just get into this much because this is it's no longer relevant, so I'm not gonna really get into it. I just want you to know that it's changed as of 2001. As far as business combinations, now we do the acquisition method instead of the pooling of the interest. So that's really all you need to know, is that it used to be the pooling of the interest. I'm not concerned about getting into the theory of that because I don't want to confuse anybody. The evolution of accounting methods. So FASB statement number 141 from the year 2001, it eliminated the pooling method. So the pre-2001 combinations accounted for under the pooling may continue, so they don't have to change make the changes reflective in their accounts is what that means. So any combination that happened before 2001, they can continue to go and operate and carry those assets on their books as they did. The purchase method recorded fair value assets acquired in the purchase. Okay. The FASB statement number 141R of 2007, ASC 805, and ASC is Accounting Standards Codification, is what that is short for. The acquisition method, all assets and liabilities recorded at fair value regardless of the percentage interest. So when you get into consolidating companies, a lot of times there will be a non-controlling interest, a portion in which you either cannot purchase, or a percentage that's just out there from other non-controlling interests. Discontinuing the discontinuing of fixed and intangible assets to values less than fair value. So pretty much what we're moving to now is we're recording stuff at fair value, right, regardless of the amount that we own. Okay, applying the acquisition method. So first we want to identify the acquirer, right? So who is the person actually acquiring this company? Then next we need to determine the acquisition date. So when is this date of acquiring this company? The date is used to establish fair value of the company acquired. So at whatever date point in time is the estimates of fair value that we're going to use. All right. So we want to measure the fair value of the acquiree, right? So what we mean by that is, but we want to look at their books. They're going to have a book value of where they're carrying their assets, and then we're going to have the fair values, right? So we need to measure the fair value of the acquiree. So that needs to, there obviously those are going to change. For the book values and fair values will most likely differ. And then we want to record the acquiree's assets and liabilities that are assumed. So net assets are going to equal the excess of assets over liabilities. So same thing here. Net assets, net equities, same thing. Assets over liabilities. Fair values are determined per ASC 820. So once again, that's the Accounting Standards Codification 820. You'll hear a lot about that in this course. And also if you go to sit for your CPA exam, identifiable assets never include pre-existing goodwill. So if a company has pre-existing goodwill on their books, then it's not an identifiable asset. So we can't include pre-existing goodwill. Only new goodwill is recorded in an acquisition. So what do we mean by new goodwill? New goodwill, we'll get to it, but it's the only time a parent or a company can recognize goodwill on their balance sheet as an intangible asset, as a long-term asset, as a non-current asset, as if they actually acquire a business. So if you look at a company's balance sheet and they have goodwill as an intangible asset, then they've acquired another company at some point in the past. Okay. So bargain purchase. So what's a bargain purchase? $500,000 for a company, and that was the amount paid, right? But let's say now the net identifiable assets were $750,000. So obviously you're going to have a bargain purchase on that, because you're actually receiving stuff that the fair value is higher than what the price paid was. So you, in essence, have just made a gain of $250,000 of $250,000, because the net identifiable assets fair value is higher than the price paid. So you could then turn around and sell it on the market price and make that gain. So that's why it has to be recorded as a bargain purchase. Valuation of identifiable assets and liabilities. So current assets recorded at fair value. Valuation accounts are not used. Existing liabilities recorded at fair value. So current assets recorded at fair value, existing liabilities recorded at fair value. Property, plant, and equipment recorded at fair value, and accumulated depreciation is not. That's an important note here. Accumulated depreciation is not going to be recorded during the acquisition process. Existing intangibles other than goodwill recorded as estimated fair value. Assets scheduled for sale are recorded as net realizable value as current assets. So we already know net realizable value is going to be the price that it's expected to sell for less the cost to complete the sale or to make the sale possible. So that's what net realizable value is going to be. You all should be familiar with net realizable value from your intermediate course. So pretty much you can see a little trend here. Everything's based upon fair values at the date of acquisition. Valuation of identifiable assets and liabilities. So what if the acquiree was the lessor of an asset in use? Okay, so leases retain their definition in terms if the terms are not modified. So once again, remember we have capital leases and operating leases. This would be another topic that you're familiar with from your intermediate. Or record an estimated liability if the terms are unfavorable. So what do we mean by if the terms are favorable or unfavorable? So what we mean is, say for this example here that if that we're having to pay in excess of fair rent value over contractual amount of $300, right? The period of 60 months, because it's for 5 years assumed at a rate of 8%, then the present value would be $14,894. So let's not really get too much into this example here. I know it's kind of vague, but it's just the main thing here. Let's just get the theory now. We'll worry about the examples later. For the operating leases, if it's a favorable in terms, then we do record an intangible asset. If it's unfavorable in terms, then we have an estimated liability, which makes sense. So acquiree acted as a lessor. Okay, leases retain their definition and terms are not modified, right? So same thing here. As long as there's no modification to the terms, then they retain their definition. So now operating lease. The asset under lease is on the books of acquiree. It's recorded at fair value. Evaluate terms. Record asset liability if favorable, or if unfavorable to the acquiree or lessor. So pretty much same thing here, just on the opposite end, opposite spectrum. So intangible assets not currently recorded by the acquiree. So this is going to arise from contractual or other legal rights. Or if it's separable. So the identify and record separately allows for recognition that the acquiree was barred from recognizing. So intangible assets not currently recorded by acquiree. So what's this saying is we've identified some intangible assets that were not previously on the books of the acquiree. And like it says here, it arises from contractual or other legal rights or is separable. What that means is pretty much some examples of the intangible assets that are identifiable. It could be market-related intangible assets like trademarks or trade names, stuff like that. Internet domain names, even customer list or customer basis, stuff like that. So that's what we're talking about here. So research and development. Fair values of tangible and intangible assets are recorded. The contingent assets and liabilities possessed by acquiree on the acquisition date. So what do we mean by contingent assets and liabilities? So pretty much it could be like, say maybe they have an unresolved lawsuit that hasn't been done, or if they have like bonuses or the lawsuit that has been settled, or if they have bonuses to like their current employees or management that hasn't been paid yet. So these are going to be some contingent assets and liabilities that we still have to recognize because they were of significance or if they were relevant at the date of the acquisition. The liabilities associated or exit activities. So existing. So that would be another one. Employee benefit plans. So asset if projected benefit obligation is less than plan assets, or liability if projected benefit obligation is or greater than plan assets, and then the second one less than plan assets. So asset if the benefit obligation is greater than plan assets, And then liability of projected benefit obligation is less than plan assets. So everyone should be familiar with pensions as well. So that's what we're talking about here with employee benefit plans. Pensions was covered in intermediate, and on the balance sheet when we deal with pensions, that's what determines whether they have it put as an asset or a liability on their balance sheet. That's what FASB they state has to happen when a company sponsors a defined benefit pension plan. So once again, if the fair market value of the plan assets is going to be less than the projected benefit obligation, asset liability if it's less than plan assets. So deferred tax assets and liabilities is also on there. So a little more on applying the acquisition model. So here's just an example here. You can see here, this is the balance sheet on the actual books of the acquiree. So if we're going to acquire this firm here, here's a snapshot of their balance sheet at the beginning of October of 2017, October 1. And then according to FASB's accounting standard codification of 820 on 10/1 of 2017, these are going to be the fair values. Because remember, we're concerned with the fair values as opposed to the new acquisition method of accounting. So we need to look at these and then compare them with that of the fair values, right? So we can see here cash 40,000. Marketable securities is on the balance sheet as 60,000, but this is a level 1 because they're marketable securities. If you recall the inputs for determining fair value, this is another thing you should have learned in intermediate. You have level 1, level 2, and level 3 inputs for determining fair value, with level 1 being the highest, the most trusted one that you should use. Level 1 being if like it says here, marketable securities, they're traded in an actively traded market. They're holding them, so they can be determined at that point in time. All you have to do is see what they're trading on at the active market. So that's why this says L1 market 66,000, because this is what these marketable securities are actually trading for. Because at the end of a reporting period, just say this company is standing alone, at the end of the reporting period, they have to mark these to market on the balance sheet date at the end of the year. So obviously that it's changed since they've done that at the end of their previous year. They've increased the value by $6,000. Same thing, inventory, level 1 market. Land, level 2 adjusted market. Level 2 is going to be identify or assets that are similar or pretty much identical in nature, that are traded on a market. So they're just similar, but then those are traded. So that's what the level 2 is. We're just looking at stuff like that. So land obviously is going to be level 2 adjusted market. The building, same as if it doesn't exist, if it's not actively traded, or if there's not anything that we can compare it to within another market, then we use our own entities or management's best assumptions as to what the estimate of fair value would be. And level 3 is the lowest level estimate based upon the acquiring company of what they think it would be. Current liabilities, same thing, book value, the face value for the bonds, the premium on bond payable, once again, level 2, adjusted market, and then the warranty liability, level 3, other estimates. So that's just going to be internal as well. And notice that your equity accounts here is unchanged. So we're going off what the actual true equity accounts are here. So here, the fair value of the net identifiable assets, if we sum all this stuff up, it'll give us $705,000. Looking at the balance sheet, these are the carrying values, but when we apply the acquisition model, we have to take all these to get their fair market values for assets and liabilities, right? So that's what level of inputs are.